Again, there's a little bump in 20 years. No, 235, but for 10 years, it's 199 and so on. Okay, now inflation is not an issue. We're not worried about the short-term potential recessions either, because we're starting at 5 years. If anybody's going to tell you that they're concerned that there's going to be a recession starting 5 years, they don't know what the hell they're talking about. Because given our statistical skills and given the laws of nature, actually, that's not an easy statement to make. And I've done these things for a living. Anybody who forecasts economic activity beyond 2, 3 years are basically making big time guesses. Next year, 3 years, some of them are better than the others. But I don't know. In fact, if you want the best forecast, typically you get the forecast of hundreds economists, average them up. That average almost always happens to be, in terms of forecast quality, better than the best of the forecasters. It's again another laws of statistics, because you're an economist, you work with one set of information. You're an economist, you work with another set of information, but there are differences. When I aggregate them, the averaging actually puts all of those together. But even with those, anybody who forecasts 5 years economic growth 5 years from now, they're just major guesses. That's about it. There's no reason why, by itself, there should be almost a 80 basis points difference between the yields of the 5 years tips versus 30. So it is not based on forecasts of economic activity and should not be. But there is something else, even if liquidity is not an issue. Let me find my bond portfolio thingy. And we've done this before, but let's say I have a 5 year treasury bond, 161. Currently it's trading at the face value. So let's do this. If tomorrow, for whatever reason, market was concerned that interest rates should go up, and this went to 2%, the yields, price of this bond is going to go down quite a bit, and you're going to lose, let's see, 8.8% of your investment. You're probably thinking, I bought this bond, it sits in my portfolio. I'm a pension fund, let's say. Okay. And so if I don't sell it, I don't lose money. You should never be in that mindset. Two, some people are actually are not pension funds. I think we talked about why Silicon Valley Bank went down. Banks, as you know, have to keep liquid assets for reserves. Silicon Valley Bank had slightly over $200 billion in assets. And of those, about half were long-term treasury bonds. They're thinking they're not even taking default risk. So that's not a problem. The trouble is you got to fund those portfolios. The capital of Silicon Valley Bank, when it was considered healthy, was probably $12 billion. That's a normal thing for banks. No, $20 billion. 10% capital ratio is considered very healthy. So if something happens and Silicon Valley Bank cannot fund $10 billion, they're going to have to use their capital and go bankrupt. The way you fund a portfolio like that, you tend to fund it in repo markets, the overnight collateralized loan. If I have those 5-year bonds and they go down 8% in value, originally I paid only $1,000 for it, so I need to fund $1,000. Now I can fund only 912 because nobody's going to lend me $1,000 when I give them a collateral that's worth only 912. Even that 912, they're taking a little bit of risk, but since it's overnight, it doesn't make too much difference. That means I effectively lost $8 billion of funding if you round it up Silicon Valley to 100 billion. I only had 20 billion, so I lost my capital adequacy ratio went from 10 to 6. At 6, they wouldn't take you down. Okay. Now let's see what would have happened if those bonds were actually 30 years. Oh, this was 30 years. I'm sorry. Let's do 5 years. If my bonds were only for 5 years, I would have lost only 2%. So over that $100 billion of bonds I have, I lost only $2 billion worth of funding. I can survive that. I mean, these Silicon Valley people were different, but as a bond book manager, I would be concerned about that. So if I have a choice to carry my liquid funds in 5 years versus 30 years, and they yield exactly the same, which one would I have picked? 5. Why? Because 5 gives me less risk. That means, and this is called so-called the duration risk, the bonds that are of higher maturity or longer maturity carry more interest rate risk. The risk investors would be exposed to if interest rates were to go up. I mean, at the 30-year bond, I can go bankrupt or get close to it. Trust me, if a bank like Silicon Valley Bank went from 10 to 6 in capital adequacy, there is going to be a bank run, and there was a bank run. Because I have a lot of deposits there. Most of their deposits were not insured because they actually lent to these venture capital and startup firms. They also kept their business over there. I'm concerned, I need the money. If Silicon Valley goes down, I may not be able to get that money. So I'm going to go ahead and withdraw it, put it in JP Morgan. Maybe I'll get a little bit less interest, but I'll survive. And there was a run on Silicon Valley Bank. And the more there is run, the more they have to sell those bonds. And it's kind of snowballed into it. Why? Because they did not worry about managing the risk. But not many people are idiots like that. If I'm running a book, I'm going to demand a premium on the longer term. Even if I have complete expectation that inflation is going to remain exactly the same. In fact, with the real stuff, that's not even an issue. That's why the real part of the yield curve almost always, except maybe for the very short end, has to be upward sloping. That is an interest rate risk premium. Now, to that, we're going to add some sort of, let's see, this is the real curve. Going to add maybe, let me use a different color. Inflation expectations. Maybe I expect a little bit higher inflation in the future than now.